Welcome to the Deep Dive. Today, we're really digging into Senores Pharmaceuticals Ltd. They're a global, research-driven pharma company. Our goal here is to unpack their latest performance for you financials, operations, strategy for Q1 FY26. That's the quarter ending June 30, 2025. And we've got quite a bit to work with. Board meeting notes, the detailed financial results, an investor presentation, a media release, all fresh from July 23rd.
Exactly. And we want to show you what all this paper actually tells us about the company's health, where they're headed with expansion and how they fit into this, well, very fast-moving global pharma scene. We'll cut through the noise for you, get straight to the key insights.
Okay, let's start at the top then. The headline is, Senores Pharmaceuticals reported, strong financial and operational numbers for Q1 FY26. And strong really means something here. Total income, all 138 crores.
Right.
Now, that's a jump of 72% compared to the same quarter last year. 72%. And even up 15% from the previous quarter.
Yeah, that top-line growth is pretty striking. But what's really interesting is how it's translating down the income statement. Look at EBITDA earnings before interest, taxes, depreciation, and amortization. That climbed to Rs 34 crores.
Which is a 60% increase year over year.
Exactly. And profit after tax, the PAT, that almost doubled. It hit Rs 21 crores, which is up a huge 95% from Q1 last year.
Wow. So not just selling more, but keeping more of it as profit.
Precisely. It shows improving efficiency.
And you see that in the margins too, right? The
Wow.
PAT margin went up to 15.4% this quarter compared to 13.5% a year ago.
And one more critical piece, especially for stability, is cash flow. They reported positive operating cash flow of Rs 11 crores for the quarter.
Okay.
And management sounded quite optimistic about keeping that positive cash flow going. That's really important for funding growth without just relying on debt or equity.
Definitely. Okay, so that's the big financial picture.
Yeah.
Now let's break it down. Where is this growth actually coming from? Senores operates across a few different areas.
Right. Let's unpack the segments. The biggest piece of the pie is their regulated markets business. Think US, Canada, UK mainly. That segment brought in 65% of the total revenue in Q1.
65%.
Revenue there was Rs 90.1 crores. That's up nearly 70%, 69.3% year over year.
Huge.
And importantly, they maintained a really strong EBITDA margin in that segment, 35.5%. That points to good pricing power, cost control, the works.
35% margin in regulated markets is definitely healthy, and it looks like product development is humming along there too. They launched 2 new NDA products, those are the abbreviated new drug applications, and got approvals for 4 more just in this quarter.
Yes, that's key. They now have 24 products actually selling, 70 approved NDAs in total, and a pipeline of 57 more.
And here's something really interesting. 37 of those pipeline products have what's called competitive generic therapy, or CGT, opportunity.
And that CGT designation is, well, it's a big deal. It usually gives them 180 days of market exclusivity. Right, 6 months to really establish the product, grab market share, potentially with less immediate price pressure from loads of competitors jumping in. And Senores is actually second highest among its peers when you look at the proportion of their pipeline with this CGT exclusivity. It's a smart strategic focus.
Definitely sounds like it.
And also within regulated markets, don't forget the CMO side, the contract manufacturing work. They've got 27 commercial products there and 53 in the pipeline, shows strong partnerships.
Okay, good point. Now, shifting over to emerging markets, that was, what, about 21% of the revenue?
Yeah, 21%. That segment brought in Rs 29.7 crores. Still very solid growth there, too, up almost 32% year over year.
And they're expanding their footprint.
Considerably. They now have 308 registered products in these markets and another 719 waiting for registration. That's across more than 40 countries. Management mentioned they're tweaking the product mix and their go-to-market strategies to boost profitability in these diverse regions. It's not one size fits all.
Makes sense. Then there's the segment that really jumped out at me. Branded generics. The revenue was Rs 8.2 crores, but the growth, a massive 357.7% year-over-year increase. What is going on there?
Well, that kind of explosive growth points to a very deliberate push. Management explicitly said their monthly sales rate for branded generics has more than doubled compared to last year.
Doubled monthly rate, wow.
And they tied it directly to expanding their field force. So more salespeople on the ground promoting these brands. Plus, they've stated this ambition to be a pan-India player by the end of this fiscal year, FY26. So this looks like a core part of their domestic strategy now.
Okay, a major strategic focus then. And just quickly, the last segment, API, active pharmaceutical ingredients.
Right, API. That brought in Rs 3.0 crores in revenue for Q1, still growing, up 19.2% year over year, but obviously a smaller part of the overall picture currently.
So with all these moving parts performing well, what's the bigger picture strategy? How does management see this momentum continuing? What are the sort of underlying strengths?
Yeah, good question. The managing director laid out a few core competitive advantages that are really driving things. First, in the US, they have what they call dual channel access. They can sell to both the government, and a lot of their pipeline is geared towards that and the regular retail market that's flexible.
Okay.
Second, they have the capability to make and supply controlled substances in the US. That's a niche, highly regulated area. Not everyone can do it.
Right. Sets them apart.
Third, because their formulation manufacturing is done right there in the U.S., they're basically shielded from U.S. tariff issues on finished goods, gives them supply chain security others might lack.
Smart.
And finally, that CDMO-CMO business we mentioned, it's scaling up. They're getting new contracts, bigger orders from existing clients. It gives them good visibility on revenue for the year.
So tangible advantages. And management boiled their focus down to 3 pillars.
They did. Number 1, keep expanding that NDA portfolio in regulated markets. Number 2, steadily grow the CDMO-CMO segment, also in regulated markets. And number 3, expand the product range and improve profitability in those emerging markets. Pretty clear focus areas.
And any other strategic moves mentioned?
Yes, they're tightening their grip on their subsidiary, Havix. They plan to increase their direct ownership stake to 78% by the end of this quarter. It was 73% back in December.
Okay, consolidating control.
Gives them more direct oversight and alignment, presumably.
Now, something we should definitely touch on is the IPO. Senores had a successful IPO back in December 2024, right? Raised quite a bit of money. Cars 582 crores. How's that money being used? Or maybe not used yet?
Right. That's always a key follow-up after an IPO. As of June 30th this year, they had outlined plans to use about Rs 500 crores of the net proceeds for specific things. Out of that 500, they've utilized about Rs 31 crores.
So that leaves quite a chunk still unutilized.
It does. Around Rs 259 crores remains unutilized. And there are a couple of big items worth noting there. Specifically, Rs 107 crores that was earmarked for building a sterile injections facility at their Atlanta site for Havix, still completely untouched.
Okay. A major project still waiting.
And also, Rs 102.5 crores set aside for inorganic growth acquisitions, other strategic moves that's also still sitting there, unutilized.
Interesting. So significant capital waiting for deployment. Where is it sitting?
Well, the documents show a large chunk is parked in fixed deposits, about Rs 114 crores with HDFC Bank and Rs 140 crores with ICI Bank.
Okay, so earning some interest, but not actively deployed into those specific growth projects yet. Something to watch.
Definitely. It could suggest caution, maybe some delays, or maybe they're just waiting for the right acquisition target. But yeah, worth keeping an eye on.
So we have this picture of strong current growth, clear strategic advantages, but also this significant undeployed capital. How does Senores stack up in the broader pharma world? What's the context?
Well, stepping back, the global pharmaceutical market itself is expected to keep growing pretty steadily, maybe around 6.6% annually through 2028. And the U.S. market remains the heavyweight, accounting for something like 43% of the global total. So Senores' focus there makes a lot of sense.
And what's driving that overall market growth? We hear about aging populations, more chronic diseases, obviously heightened health awareness since COVID, plus ongoing R&D investment.
Exactly. All those factors create a favorable tailwind for the industry. So the question becomes, how is Senores positioned to actually capture that growth, especially in the U.S.? The U.S. market is tough, high standards, high costs, but it also faces persistent drug shortages.
Right, we hear about that a lot.
Which creates a real need for reliable generic suppliers, and it pushes healthcare systems towards adopting more generics.
And that's where Senores fits in, with their U.S. FDA and DEA-approved plant in Atlanta, capable of government contracts and those controlled substances.
Precisely. They seem strategically positioned to meet those specific needs. Their focus isn't just on any generics, but often niche, more complex products which tend to have better margins.
Uh-huh.
Plus, their plan for backward integration, expanding their own API manufacturing capacity quite significantly, from 25 tons per year up to 169.
Big jump.
Huge jump. Targeting regulated and semi-regulated markets for those APIs. That move should give them better supply chain control, reduce reliance on outside suppliers, and ultimately save cost. It's about building resilience and improving margins long term.
Makes sense. Okay, one last piece of news, a change in the leadership team.
Yes, relatively significant. The board just approved the appointment of Mr. Jignesh Shashikant Desai as the new president of finance. That's effective immediately, July 23rd.
Okay, president of finance. What's his background?
He brings a lot of experience over 30 years in finance, accounting, procurement within the pharma industry. He's held senior roles at other major companies. He's a qualified cost and management accountant, so you'd expect his expertise to be pretty valuable as Senores manages this growth, works on operational efficiency, and importantly, decides how and when to deploy that IPO capital we talked about.
Right, could be a key appointment given the current situation.
Yeah.
So wrapping this up, what's the main thing that stands out to you from this whole deep dive into Señor's Q1? We've seen really strong financials, clear strategic pillars, those unique competitive edges.
Yeah, they're definitely firing on several cylinders right now. The growth is impressive. The strategy seems sound. But I think the interesting point for you, the listener, to consider as we look forward is this. How will Senores balance this clear operational momentum and aggressive growth, particularly in regulated markets, with the, let's say, cautious or perhaps delayed deployment of that significant IPO funding, especially the funds earmarked for major capex and acquisitions? In such a competitive global pharma landscape, how they navigate that tension between performing well now and investing decisively for the future, that could really define their next chapter. It's a fascinating dynamic to watch unfold.